It sounds impossible, but a 67% tax on your pension is now a law. You could spend your entire life building a retirement pot only for the taxman to take more than half of what could have gone to your family. As a business accountant, I understand why these new rules leave so many people worried and confused. That's why today I'll show you exactly who is affected, how this 67% tax can happen, and what you can legally do to reduce the tax bill. To start, I'll show you how this affects you and me, not just the super rich. When most people hear about inheritance tax, they imagine mansions, massive estates, and families with more money they could ever spend. That's why for a long time, inheritance tax has been known as a rich person's tax. But from 2027, that becomes less and less true. Regular people, like you and me, could see up to 67% of their pension disappear. And later I'll show you exactly how the taxman gets to that number. But first, there is a much more important question we need to tackle. Should you actually be worried about any of this? To answer that, let me quickly explain how inheritance tax works. When you pass away, everything you own gets added up together, mainly your home, your savings, and your investments. That total is called your estate. The first 325,000 of it is completely tax-free, and it's called your new rate band. That number is actually very important, so keep it in your mind because we're coming back to it. Anything above that amount can be taxed at 40%, which is the main inheritance tax rate. However, some people get a little bit more headroom. If you own a home and leave it to your children or grandchildren, you can get an extra 175,000 allowance that takes your tax-free total to 500,000. And if you're married or in a civil partnership, you may be able to combine your allowances with that of your partner, giving you up to £1 million tax-free as a couple. Now that's the best case scenario. There's specific rules you need to meet, but reaching a £1 million allowance is technically possible. So far this probably sounds like more than enough and nothing to worry about, but this is exactly where the trap is hiding. Here's why. The 325,000 new rate band was updated in 2009 and it hasn't moved ever since. On top of that, the government has confirmed that it will stay at this level until at least 2031. Well, for the last 17 years, a lot has changed. To put that into perspective, in 2009, the average house cost 154,000, the number one song was by Lady Gaga, and this allowance has had about as many updates as your nan's Facebook password. Today, the average UK house costs around 270,000, Lady Gaga has won 16 Grammy Awards, and your 325,000 allowance still hasn't moved, so now your home alone uses up around 83% of it. And if you live in London or the Southeast, where a typical home can easily be worth 400,000 or 500,000, you can see how inheritance tax starts looking less like a tax on the super rich and more like a property tax for normal people. But what about your pension? Until now, pensions have been outside the inheritance tax rules, meaning they didn't count towards the 325,000 limit. When you died, whatever was left from your pension pot could be passed on to the people you choose without them having to pay any tax. But that's the old world. From April 2027, that becomes a thing of the past. The pension money you didn't spend will be added to your taxable estate and stacked on top of your savings, investments, personal assets, and a house that's already taken most of your allowance. And for many people, that pension could be the final thing that pushes them over the tax-free limit. Put the three main factors together and you get the perfect storm. A new rate band, frozen since 2009, house prices that have been climbing year after year, and pension pots that have quietly grown since auto-enrollment started in 2012, bringing millions of workers into workplace pension. Now, if you're married and meet all the rules, you could potentially get that 1 million allowance I mentioned earlier, but then you need to remember that for a couple, it's not one pension being put into that million, it eventually can be both of your pensions. I covered the mechanics of how this works in more detail in the video here, so I'm not going to repeat everything in this video. But what if you're single, or divorced, or widowed? What if you never had children? Or you live with your partner for 30 years but never married? In those situations, you won't be able to qualify for the 1 million allowance. The most you might get is 500,000, and even that depends on your circumstances. But before I show you how the tax on your pension can climb all the way to 67%, there is one final thing that decides whether these changes affect you. And this is the type of pension that you actually have. Broadly speaking, there are two. The first is a defined benefit pension that you might know as a final salary. With this type of pension, your employer promises to pay you a set income for life. When you pass away, those payments will very often stop, and that's why the new inheritance tax rules will have very little to no effect on these types of pensions. Interestingly, these types of pensions are now quite rare, at least in the private sector, although many public sector workers still have them. The second type is a defined contribution pension, and this is the type most people saving for retirement today are going to have. Instead of being promised a guaranteed income, you build up a pot of money throughout your working life. You pay money in, it gets invested, and by the time you retire, your pension is worth whatever that pot has grown to. That pot you've spent your entire working life building is exactly what gets put into your taxable estate from 2027. So inheritance tax may have been designed as a tax on the wealthy, but the people walking into this new trap aren't necessarily sitting in a mansion surrounded by tax advisors and lawyers. It could be someone with a semi-detached and a decent pension. It could very easily be you. You may already be over the limit without ever having thought about it. But crossing that line is only where the story starts, because a 40% tax bill would be painful enough. What can actually happen to your pension is far worse. And that's how we get to the number I promised you at the beginning of the video. Let me show you exactly how a taxman climbs all the way to 67%. To understand how a pension can end up being taxed at 67%, you need to understand something strange. The same pot of money can be taxed twice by two completely different taxes, one after the other. Here's how this works. Let's say you leave behind a pension pot worth £50,000 that you just never got around to spend. And remember what we just covered. For many people, their home had already used up most, if not all, of their tax-free allowance. So that entire $50,000 of pension could now sit in the taxable part of their estate. So here's what happens with it. First, because your pension is now part of your estate, it gets hit with inheritance tax at 40%. That's $20,000 gone straight away. Your family is now left with only $30,000. But it doesn't end there, because there's another rule you need to know about pensions. If you die after the age of 75, whatever your family takes out of the remaining pension pot is usually treated as their income, which means it gets taxed all over again. So when your children withdraw the remaining $30,000, the money gets added on top of whatever else they earned that same year. And if they're higher earners, they could pay another 40 or even 45% in income tax. At 45%, that's another $13,500 gone. So your family started with $50,000, and after both taxes have taken their share, they're left with about $16,000. Added up, and roughly 67% of your pension has disappeared. Taxed once when you died, and then taxed again when your family tried to use it. Now, to be fair, 67% is the worst case scenario. It assumes that you die after the age of 75, your pension sits fully above your inheritance tax allowance, and the person receiving the money pays the highest rate of income tax. For some families, it might be a bit better than that. Maybe something closer to 64% or 52%, depending on whether the person withdrawing the money is a basic or a higher income tax payer. But the bigger point remains. In most cases, more than half of the pension you spent decades building could disappear in tax. And at this point, I'm not even sure if the tax bill is the worst part of it, because someone has to actually deal with all the administration that comes with it. And that someone is usually your family. When you pass away, the people sorting out your affairs, usually your husband, wife, or children, now have to track down every pension you ever had. And the responsibility for paying any inheritance tax falls to your family. They generally have 6 months from the end of the month in which you passed away to pay the bill, and if they don't pay on time, HMRC can start charging interest. So this is the sequence of events that someone in the government decided is a good idea. The deadline to pay starts almost immediately. The people you love are trying to track down pensions from decades ago. They chase valuations from companies they've never heard of, working out how much tax needs to be paid, and they go through all that only to end up handing more than half of it back to the taxman. So you do all the work and you pay the bill too. Now, before we go any further, I want to make it clear that I'm not telling you to cancel your pension or stop paying into it because of these changes. They are still a great tool for securing your retirement, and there's actually a lot you can legally do to reduce the amount of inheritance tax. And some of the things are far simpler than you might think. So let me show you exactly what you can do about it. The whole 67% tax trap I've just shown you actually has one major weakness. It can only touch the money that's still in your pension when you pass away. Money you've spent, enjoyed, or given away during your lifetime is a whole different story. So the problem isn't necessarily having too much money in your pension. The problem is leaving behind more money than you actually needed. Now, I'm not telling you to empty your pension and blow the lot on a Lamborghini the day you retire. Your pension still has an important job. It needs to pay for your retirement and make sure you have enough money to live comfortably for the rest of your life. We're only talking about the surplus, the money you genuinely don't expect to need. So what can you actually do with them? One of the most powerful options is something hardly anyone talks about. It's about giving money away from your regular income. What makes this useful is that if you follow the rules, these gifts can reduce your taxable estate straight away. With other gifts, known as potential exempt transfers or PETs, you need to live for 7 years after making the gift for it to no longer count as part of your estate. But I'll cover these in more detail in a minute. Gifting from your regular income only works if you follow these 3 rules. First, as the name suggests, the gift needs to come from your regular income, and money from your pension counts as regular income. So this is the first one checked. Second, the gift needs to form part of your normal spending. In simple terms, HMRC wants to see a pattern. So instead of suddenly handling your children 50,000 one afternoon, you might give them 1,000 each month for a longer period of time. And finally, after making those gifts, you still need to have enough income left to maintain your standard of living. So let's say you regularly receive 50,000 a year in income. You give 1,000 a month to your family, which comes to 12,000 a year. And that leaves you with 38,000 to live on for the entire year. If that's still enough to maintain your normal lifestyle, the gift could qualify for the exemption. And by following these 3 rules, you could gradually reduce the amount of money left in your pension while helping your family at the same time. But that's not your only option. There are also several smaller allowances that many people completely forget about. You can give away up to 3,000 each tax year using your annual exemption. You can make small gifts of up to £250 to different people, and you can make larger tax-free gifts when someone gets married, with the amount depending on your relationship to them. And none of this requires some complicated offshore structure or a team of expensive tax lawyers. They're simple rules that allow money to leave your estate while you're still around to decide where it goes. But what if you want to make a much bigger gift? That's when the potentially exempt transfer I mentioned a second ago comes in. Let's say you give your child £50,000 towards buying a home. For inheritance tax purposes, this is known as a PET. It's called potentially exempt transfer because it falls completely outside your taxable estate only if you survive for 7 years after making the gift. Live those 7 years and that £50,000 is gone from your estate for good. You don't pay any tax on it. But if you don't survive for this period, the full 50,000 comes back into your estate. So with a gift like this, the earlier you start the planning, the better. Now there are other options beyond this, such as annuities, trusts, life insurance arranged in the right way, and more complicated estate planning structures. Some of them can work extremely well, but that's usually the point where a qualified financial advisor or tax professional becomes important. But for many people, the starting point is much simpler. Work out how much you genuinely need, look at what you're likely to have left over, and start thinking about whether some of that money could do more to your family now rather than sitting untouched in your pension for another 20 years. I think that when you spend your whole life working and saving money, you should have a say in where that money eventually ends up. And under these new rules, doing nothing could become the most expensive decision of all. But protecting your pension only matters if there's something left to protect. If you're running a business, you may be overpaying the taxman every year long before a single penny reaches your pension. So watch this video next, where I show you the everyday expenses you can legally claim keep more of what you earn.